This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down. Many people are coming around to the idea that we're in a recession or we're going into a recession. The first 2 quarters with real GDP growth negative to us means we're in a recession. And now that many people are worried and are beginning to see recession for as far as the eye can see, we are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang, and that it's going to be a serious inventory correction, but it's not going to be anything like we saw in 08, 09. That was a systemic financial problem caused by the mortgage and financial meltdown. We don't think this is the same thing. So now that many economists are starting to agree with us.
The CEO of ARK Invest, Cathy Wood, wrote an open letter to the Federal Reserve expressing her disagreement with the Fed's recent measures to control inflation. Experts and market participants anticipate another rate hike of 50 basis points in November, and Cathy is entirely against any future rate hikes by the Fed. In a letter to the Federal Reserve, Wood said the following: "The Fed seems focused on 2 variables that, in our view, are lagging indicators, downstream inflation and employment, both of which have been sending conflicting signals and should be calling into question the Fed's unanimous call for higher interest rates." During an interview with Yahoo Finance, Wood reiterated her stance and highlighted that the current Fed strategy is considerably worse than Volcker's in the 1970s, since the percentage rise and duration of the increases were both smaller under Volcker. Wood said that this gave businesses and consumers more time to prepare for the changes. Therefore, the Fed's current rate of raises is much bigger and is occurring much more quickly because the economy isn't reaping the full benefit of each increase in interest rates. Cathy asserts that this will soon lead to a collapse, despite the fact that lagging indicators suggest otherwise. Before we listen to Cathy, if you are new to this channel or not yet subscribed, make sure to subscribe to keep updated with our daily current content and news.
If you look at what's happening in the pipeline, what you're seeing in terms of commodity prices are some very serious declines, both from their peaks and year over year now. So that is, we would say that's upstream inflation that is heading towards the PPI and then ultimately the CPI. We've got gold prices, and in fact, I looked at them yesterday. I had thought that the last 2 years, gold had been trading within the $1,700 to nearly $2,100 range. And that's true, it has, and it has broken down. This is a really good leading indicator of inflation. What caught my surprise yesterday was looking at where gold was in 2011, it was roughly this level. So you can say since 2011, more than 10 years, we haven't had a big burst, a big breakout in the gold price. And that is informing our decision here. Gold is a leading indicator of inflation, and it has not broken out. It is breaking down. And then the second thing that we're looking at is the inventory glut around the world, and especially in the United States. It looks like some of the best supply chain managed companies in the world have over-ordered. They ignored their automated enterprise resource planning systems, so ERP systems, and double ordered, triple ordered, so that Nike, for example, its sales were up only 3.5% globally last quarter, and yet its inventories were up 44%. And in the United States, they were up 68%. And if you look at in transit, they're up 85%. That's just one indication. We're seeing lots of inventory overhangs, and even online sales are suffering. Amazon just had its second Prime Day, and it showed no increase, which is really from a year over year, which is telling us that either units are down or prices are down. So I think the CPI that we got today is a lagging indicator. It always is a lagging indicator. And we're seeing a lot of prices in the pipeline that are falling.
Cathy, let's talk about what this means for the Fed in your open letter to the Fed, where you urge them to consider some of what you're talking about right now. The market, after today's data, is now more fully pricing in not just a 75 basis point increase at this upcoming meeting, but at the one after that as well. Do you think the Fed should be done? Do you think they should even raise 75 basis points at this upcoming meeting? Or do you think they should stop here and give some time for their increases to make their way through the economy?
Yes, as we're thinking about this question, we compare what Chairman Powell is doing to what Chairman Volcker did in the late 70s, early 80s, when he was fighting an inflation problem that had been building for 15 years. Vietnam War, Great Society, closing the gold window. That was a real inflation problem that built up over 15 years. This inflation problem has been 12 to 15 months by the time the Fed started addressing it. And we think it's much more a function of supply chain imbalances caused by COVID, and then again by Russia's invasion of Ukraine. These are very different circumstances. So what the Fed has done this time around is it has increased interest rates. If they go another 75 basis points, which is very likely on November 2nd, they will have increased interest rates from 0.25 to 4%, and that's a 16-fold increase. What did Volcker do? In the early 80s, he took interest rates from 10 to 20%. That's a twofold increase after consumers and businesses had gotten used to dealing with inflation and working around it over 15 years. This is a real shock to the system. And I do believe we will see the ramifications in many ways. We're seeing housing shutting down, and I think we're going to see a lot of other activities shutting down as well. We believe we're in a recession, and we believe this recession now will be sustained. And if we see an increase in GDP, it's probably because either inventories are continuing to increase or imports are coming down as companies try to unwind their inventories.
Cathy, so do you see a severe recession, and then how long do you think this bear market will continue?
What's interesting, I think many people are coming around to the idea that we're in a recession or we're going into a recession. The first 2 quarters with real GDP growth negative to us means we're in a recession. And now that many people are worried and are beginning to see recession for as far as the eye can see, we are looking at this recession a little bit differently. We think it's going to be a function of this massive inventory overhang, and that it's going to be a serious inventory correction, but it's not going to be anything like we saw in 08, 09. That was a systemic financial problem caused by the mortgage and financial meltdown. We don't think this is the same thing. So now that many economists are starting to agree with us that we're in a recession or going into a recession, we feel that they might become a little bit too alarmist if this is just an inventory recession. And I think the Fed will have a lot to do with whether or not it is. This is a shock, though, to the system. And this idea that we have an inventory overhang, we think it's going to get bigger as consumers pull back. Low saving rates, 3.5% versus 8% where it was before COVID. And so we'll see. We think this holiday season is going to be pretty tough.
And so as you ready your shopping list for that holiday season, Cathy, when you think about some of the kind of ways that equity valuations are starting to price in that recession to the best of their ability, is there a big buy that you now think through or evaluate going into the end of the year here?
You have to consider the source here. And our focus, our sole focus, is on disruptive innovation. And we also believe that innovation solves problems. We had a tough time going into COVID with our kind of strategy. And then we had a boom in our strategy during COVID because guess what? We needed the genomic revolution to help sequence the coronavirus and figure out tests and vaccines. And our kinds of companies helped with that. We think with supply chain issues and with the food and energy prices caused by this shock, this Russia's invasion of Ukraine, that once again, innovation is going to help solve these problems. Electric vehicles, there's an accelerated consumer preference shift towards electric vehicles like Tesla because of oil prices. And we think there's no stopping that trend now. And in terms of food prices, we do believe that gene editing is going to help us figure out how to produce crops in areas that are less fertile than the Ukraine, the breadbasket of Europe, with less water, less fertilizer, less pesticide. So we're going to continue to see the miracles associated with the genomic revolution, but our other strategies as well, whether we're talking about robotics, solving the labor shortage, energy storage. I mentioned electric vehicles pulling us away from oil consumption, artificial intelligence, which is going to help every company become more competitive if they use their data and combine it with other data in effective ways. And then blockchain technologies, which is going to take the middlemen out of a lot of businesses and take the cost out of a lot of businesses, helping us to solve this inflation problem. Again, consider the source. We think innovation solves problems. It certainly gave us an appreciation of that during COVID. Our strategy was high flying, and we think we have even more problems right now. Stay tuned.
Check out the link in the description to view the full interview. Also, what is your take on Cathie's interview? Do you think the feds will continue to bail us out, or what kind of ramifications will we see?